A banking paradox emerges when strength and vulnerability share the same quarter. In the first quarter of 2026, Bank of the Philippine Islands delivered what investors typically crave: robust net income, formidable franchise strength, and liquidity, all appearing comfortably dull in the best sense. But beneath these headline numbers lies a more nuanced story. BPI posted consolidated net income of 17.02 billion pesos, converting nearly 30% of every peso in interest income directly into profit. Core operations were firing. Net interest income rose 13.7%, fee businesses expanded, and net interest margins edged higher, a sign of healthy spreads in a challenging environment. Other income sources, from insurance to foreign exchange, contributed meaningfully, demonstrating that the bank wasn't leaning solely on lending. Yet resilience came at a cost. Expenses climbed nearly 16%, driven by higher compensation, technology investments, and operational needs. Modernizing a banking franchise requires more than vision. It requires capital. Cost-to-income ratios worsened, underlining the reality that digital strategies, while enabling growth, don't erase rising tech bills. The more pressing concern came from credit risk. Impairment losses soared 83% to 5.5 billion pesos, as BPI proactively provisioned against uncertainty. While the non-performing loan ratio of 2.42% remained below industry averages, elevated provisions muted profit growth. Strong revenue gains translated into only modest improvements in income before tax. Then the bond book delivered its lesson. Rising rates drove mark-to-market losses of 13.59 billion pesos on FVOCA securities, pushing total comprehensive income down to just 2.86 billion pesos from 18.34 billion pesos a year earlier. Here is the paradox. The bank earned well by traditional measures, but market forces nearly wiped out those gains at the equity level. Net income reflects operating success. Comprehensive income tells the fuller story of balance sheet volatility. Meanwhile, BPI's balance sheet shifted toward liquidity as corporate lending edged down and government securities holdings grew. Capital ratios remained above regulatory minimums, but accumulated losses on securities widened, tempering returns. Quarter on quarter, loan growth slipped and returns softened. For investors and analysts, the question is not whether BPI can earn, its engine is strong, but whether rising costs, credit provisioning, and bond volatility are temporary headwinds or signs of a more expensive era for banking. BPI stands resilient, but its quarter cautions. Profitability may be robust, yet broader market risks can rapidly erode the shine on even the strongest books. This is the reality of modern banking. Strength must be measured by both earnings and the resilience of the balance sheet. The path forward will require careful navigation of risk, cost, and growth.